Now, let's try to understand a little bit on this particular topic. For the fixed income securities, looking at what the prices mean, what the discount factors mean, and what is the concept of arbitrage. So, here we would be focusing more on a very brief introduction into for a fixed income security, for a fixed rate government bond, what are the typical cash flows that are there? What do we mean by prices, discount factors, an important aspect called the law of one price, and how does this law of one price play a role in the arbitrage creation, arbitrage opportunities? How do I create a replicating portfolio? How do I replicate the cash flows of one bond using a set of two or more other bonds? How do I replicate the cash flows? So this is one important aspect that we'll be looking at. And when I'm trying to predict the price of a bond with respect to the other bonds, why is that my predicted price slightly different from the market price? What are the reasons for it? And what do you mean by strips? And we also will look at the idiosyncratic pricing behavior of the treasury bonds. Means bond specific pricing. That is what we typically call as idiosyncratic. So what is the bond specific pricing behavior? And we will talk about a few terms like accrued interest and how does accrued interest play a role in terms of pricing of the bonds. And we will just try to understand what are the various day count conventions that are available to compute the accrued interest. So these are the various things that we are taking up in this session. Now, try to understand the typical cash flows from a traditional fixed rate government bond. Any government or any fixed income security, what are the traditional cash flows that are there? One is the face amount, which comes on the maturity. Every fixed income security has a proper maturity date. So there is a face amount that is paid on maturity. Sometimes it is called as a principal amount or sometimes it is called as a par value. The names are different but they mean the same. And there is a coupon rate associated with every fixed income security, which is a kind of recurring payment that occurs, right? It's a recurring payment at regular intervals of time. So in many cases it is paid on a semi-annual basis. Some percentage, it is generally some percentage of the face value, right? Some percentage of the face value paid at every semi-annual period or in some cases annual mode. That is called as a coupon. And there is a maturity date very clearly mentioned for each of the fixed income securities. So just look at a simple example. Let's say today is May 2010 and we are talking about a US Treasury bond, right? The US government has sold a bond with a coupon of 2.125%. This is the way it is expressed, which means 2.125% of the face value is paid every year. Now, if it is a semi-annual kind of a coupon, then only half of it is being paid, which means 1 point, right? Probably instead of 2.125, I can talk about 1.0625% is being paid every 6 months, right? That's the important point. So this is always expressed in annual terms. Depending on whether the payment is annual or semi-annual, either the full amount of this face value is paid or 50% of it is paid every period. And we talk about a maturity of this much. Now, if I am purchasing that kind of a bond, US Treasury has sold that kind of a bond. Now, if I am purchasing, let's say 1 million face value of the bond, means this is how I am going to get the coupons and the principal. So, 2.125% multiplied by the face value, which is 1 million, and this 125% is an annual, but the coupon is paid in a semi-annual basis, which means I'll take the 0.5 of that. So this number should give me what is called as 10,625, which is being shown here. Means every 6 months, 30th November, 31st May, 30th November, every 6 months, if I have invested in that particular bond, I would be receiving 10,625. The coupon payment is done every 6 months, which is equal to the half of that annual coupon rate. Expression wise, it's always an annual coupon. So what I am receiving is half of that. And on the maturity, which is the 31st May 2015, along with the last coupon, the principal amount will be refunded. The face value is also added. So my cash flows are, these are the numbers at different points in time. And just to give one more important point, if at all any of these days is a holiday, is not a working day, then typically the payments are made on the next business day. Just a small point to consider, right? And this is the case not just with US, probably across the world. The government bonds, they behave more or less in the same manner. Probably the only difference being the frequency of the payments. In some countries, probably it could be an annual frequency, whereas in US, it's more on a semi-annual payment mode. Apart from that, the coupons, the principal, the conceptual aspects will remain more or less the same. And with respect to United States, the settlement of the treasuries is T+1, which means today if I am purchasing the bond, the actual exchange of the bond and receiving the cash, or if I am purchasing it, the selling of the giving of the cash and receiving the bond will happen after one business day. The entire settlement will happen after one business day, just for information purpose. Now, there are so many such kind of bonds that are available in the market. Now let's look at, I've just documented a few of the prices. As on 28th May 2010, these are the different kinds of bonds that are available. Like this, some hundreds of bonds are available in the treasury bonds are available in the market. So let's look at a few of them. Like this is a 1/4, so which is nothing but 1.25% coupon bond. It is maturing on 30th November 2010. It's only 6 months to maturity. Currently in the market, the price of it is 100.55. And probably if I am looking at it, this is 4.75% coupon bond. It is maturing on 31st May 2012. Imagine the current date is 28th May 2010, which means 2 years from now, the maturity of this bond is happening, and currently in the market, the price of it is available at 107.966. Now this is how I can think of probably 9 different bonds. I've collected the data of 9 different bonds that are available in the market, which are maturing more or less exactly 6 months after each one. Everything is maturing exactly 6 months after the previous one. But you will find it for various other maturities also. Now a few things. These prices are mid-market prices. What are these mid-market? They are the average of the bid and the ask price. Bid is something which the dealer, not you, which the dealer wants to buy it, and which means you will be selling it. If you are an investor, you will sell it at the bid price because the dealer will buy it at that price. Ask is a price at which the dealer will be selling. The dealer is asking that particular price. So the dealer will sell at that particular price, which means the investor has to buy at that particular price. So obviously the ask price will be higher and the bid price will be lower. And the difference between these two is what we always call as the bid ask spread. Right, so in general what happens is the price, if I am seeing here, it's the average of those two. That is what I call as the mid market price, and these prices are full prices. There is a difference, we will see slightly later also. There is a difference between the quoted price and the full price. Generally, the quoted price plus accrued interest is going to be the full price, which is the price the buyer has to pay. This is the price that the buyer has to pay for the bond, which is more or less equal to the flat or quoted price of the bond plus accrued interest. Now here if we look at these bonds, they are either maturing or making the payments on the same cycle every 6 months. Probably if I am talking about let's say 30th November 2011, I could see the first bond will make the first bond is anyhow expiring or maturing by that time. The second is also maturing by that time. The third will mature on 30th November. But look at the fourth one. It will pay a coupon on 30th November 2011. Even the fifth one will pay a coupon on 30th November 2011. So all of these will pay a coupon on 30th November 2011, and this is going to mature. So the cash flows are typically happening on one single day, which means whatever their pricing is, it is purely on the amount that is received on that particular day. So that's the reason we will, especially for some kind of pricing aspects, we'll try to choose the bonds that fall into a similar kind of a cycle so that the pricing can be done more and more appropriately. Now, from here comes our understanding of a term called discount factors. And generally the discount factor is associated with a particular term. So I can call him as this 6-month discount factor, 1-year discount factor. Generally we denote it by D of T. That for that particular period, if I am saying D of 2, it is the discount factor for a 2-year period. And the way I am defining it is the present value of 1 unit of currency, let's say $1. The present value of $1 that I am receiving at the end of that particular term. Let's say 2 years. Where if I am receiving $1 at the end of 2 years, what is the present value of that? That is what we call as the discount factor. So if I am saying discount factor of 0.5 is 0.99925, it means that the present value of $1 that I am going to receive after 6 months, right now it is equal to 99.925 cents. And generally what we do is we will extract it from the treasury bond prices. Let's see how we do it. Now this is what the treasury bond is. Right, it's paying a coupon of 1.25%, maturing 6 months from now. The current price of it is 100.55. Now what we are saying is the price is equal to the present value of all the future cash flows. Now what is the future cash flow for this particular bond? It is today is the May ending. So the cash flow wise, after 6 months, I am going to receive 1.125% coupon by 2. 1.25% coupon by 2 is what is the coupon that is coming on a face value of 100. So this is the amount that is coming in the form of coupon. Right, this is the amount that is coming in the form of coupon, and because that happens to be the maturity date also, even the principal amount of 100 also is refunded on that date itself. So these two are the cash flows that are coming on that particular date, which means I can very well discount them with a D.5, which is a discounting factor, which gives me the present value of that cash flow that is coming after 6 months. So these two should be equal. What are we saying? The price of the bond should be equal to the present value of the future cash flows. So whatever are the future cash flows, which is the principal, along with the coupon, I'm multiplying it with the discount factor for the funds that are going to be received in 6 months. Now based on that, I'll get the discount factor for 0.5 period. So for that, okay, let me call semi-annual coupon that is received in each of the periods. So this number divided by 2, I'm multiplying it with 100. So here the coupon that is going to come semi-annual every 6 months, these are the coupons that are going to come. So what does this mean here? 100.55 is equal to 100.625, right, multiplied by D.5. Now D.5 for me comes out as 100.55 divided by 100.625. So here the discount factor simply comes out, at least for the first one, it comes out as the price divided by 100 plus whatever is the semi-annual coupon that is coming up, which is working out to 0.999255. So this is how we are getting the discount factor for the first period. Now imagine for the second, which is the D of 1. If I want it, I'll take a 1 year maturing bond. Now what are the cash flows? I'll receive 2.4375 after 6 months. So I'll multiply this with D.5. And I would receive again 2.4375, and along with that a principal of 100 also at the end of 1 year, because it's a maturing in 1 year. So this, so I am multiplying it with the discount factor for 1 year. This should be equal to the price of it, which is 104.513. So which means it is very much coming out that 104.513 minus 2.4375 times D.5 divided by 102.4375 is what is going to give me the D1. So which means I can compute the D1 here, which talks about the price minus the present value of the discount, present value of the coupon that is going to come in the middle, which is based on this discount factor. This entire amount I am dividing it by 100 plus the coupon amount, which is giving me that this is somewhere around 0.996. So this discount factor is working out to somewhere around 0.996. Now if you look at a generalization, what is that you can make? Look at the third one, then it makes things more easier for you. Right, it is paying 2.25. So what it comes, 2.25 comes after 6 months, which has to be multiplied by D.5. Another 2.25 comes after 1 year, which has to be multiplied by D1. And because it is maturing after that, it becomes 102.25, which has to be with a discounting factor of 1.5 years. So this has to be multiplied with the price 105.856. Now because of this, what is that I can get? I can get D1.5 quite comfortably, because D.5 and D1 are already there with me. 105.856 minus of 2.25 times, if you look at it, D.5 plus D1, I am adding all of them, and on the total I am dividing it by 102.25. So this is what I can do, so that I can do the calculation across. I can sum up all the discounting factors until the previous, and subtract that with the from the price and divide it by the 100 plus the semi-annual coupon amount. So as a generalized formula here, I can very well write the price minus the coupon amount times all the discount, all the coupons, all the discounting factors from the first till that particular period. From the first till the above period, right? So here I am taking it from the first two periods. So I am looking at D4 times, which is the coupon times the sum of all the discount factors, price minus the coupon times the sum of all the discount factors. This entire thing I am dividing it by 100 plus whatever is the semi-annual coupon amount. So this is giving me the discount factors across each of the periods. So these discount factors are shown in this way, and probably if I am looking at a simple chart for these discount factors, I could see there is a constant gradual downward slope that is occurring on these discount factors. There is a downward sloping. The discount factors are following a kind of a downward sloping pattern like this, right? So from 0.99 to 0.91. So that's how we can very well compute the discount factors, and the meaning of the discount factor is the present value of 1 unit of currency to be received at the end of a particular time period. And we could see that it is falling with respect to the term, which is very clearly reflecting the time value of money, right? Because the more and more later, longer a particular payment is, if more and more delay is occurring with a particular payment, today the worth of it is much lesser. The time value of money is applicable on the top of it, which makes it much lesser in the value, right? Now, with the same concept, let's say I want to do a pricing of another bond. I want to do the price of that bond, which is paying a 0.75% coupon, and it is maturing on 30th November 2011. So this is what is the payment. This is what is the bond I want to price. It's a 0.75% coupon bond. Now that I have the discount factors, okay, for a new bond, what are the cash flows here? It's a 0.75% coupon bond. So there is a coupon of 0.75% by 2, which is paid here, which is this much amount is typically paid. 0.38 is paid after 6 months. The same logic goes even here as well. After 1 year also there is a 0.38, and even here also 1.5 year there is a coupon, plus along with that, because it's a maturing on that date, it is receiving a principal on that date also. So the cash flows of this particular new bond are something like this. So I can multiply them with their discounting factors with these three numbers, and based on that, if I have to find out the price of that new bond, it is as good as I am multiplying these discount factors pair by pair, which is 0.38 times 0.999 plus 0.38 times 0.996, something like that. If I am doing, the price of this particular bond is coming out to 100.25. So if I am using this discount factor methodology to price this particular bond, what we are saying is the price of this bond should be around 100.2552. Okay. So we are applying the discount factor to the cash flows of this particular bond. The reason being, all these bonds are US Treasury bonds only. Whatever the discount factors that I have derived, they are using the US Treasury discount bonds itself, and even this bond is a US Treasury discount bond. So the risk characteristics, we are of the opinion that the risk characteristics are more or less uniform across the different kinds of bonds. So the value to the investor receiving $1 from Treasury at any point is purely immaterial of which bond is giving that $1, because almost all are US Treasury bonds, their risk characteristics are more or less similar. So it should not really matter from which bond that $1 is coming up. And because of that reason, and based on that assumption, the pricing is being done directly by using the discount factors that are computed by looking at the various treasury bonds and using those discount factors to compute the price. And this is where comes the law of one price, which clearly says if at all there are two sets of securities S1 and S2 which are giving identical cash flows in the future, there, let's say after 6 months they are giving the same cash flow, after 1 year they are giving the same cash flow, after 1.5 years they are giving the same cash flow. Let's say we have two different securities which are giving the same cash flow in the future. Assuming that there is no liquidity issue, both can be bought, sold, there is a market for both of them quite heavily, no issue with respect to liquidity, no issue with respect to financing. I can raise capital to buy any amount of volume of both the securities, no issues of taxes, no issue of defaulting. So under the absence of all these things, what this law of one price says is, if there are two securities which are giving identical cash flows in the future, today they need to be sold at the same price itself. If there is a difference in the price, we talk about an arbitrage opportunity, or the arbitrage profit scenario can come up, which is otherwise called as riskless profit. I can make a profit without taking any amount of risk. Now if we see here, we said that this particular bond should be priced at 100.25. Whereas what we are seeing is, if I am looking at the market price for that particular bond, from the market when I am looking at the price, it is available at 100.19, which means 0.0652 cents. It is cheaper, right? Because as per the discounting factors, as per the predicted, the price of it should be 100.25. But it is almost 6.52 cents, right? Now, okay, $0.065 or 6.52 cents lesser compared to that of what is being predicted. So this is where I may think of a replicating portfolio. We'll talk about it, right? I will try to first of all buy this bond because it is cheaper compared to the market price. Right, it is cheaper, it is cheaper compared to the predicted price. So the predicted price is coming based on the comparable bonds, right, compared to the other bonds that are there, which are used for arriving at the discount factors. Compared to that bond, this bond is cheaper. So that they are trading in some cases richer or cheaper. When the market price is lesser than this particular price, we call it as cheaper, otherwise we call it as expensive. And this is where the arbitrage opportunity might come up, especially if the discrepancies are very, very large. Here it is 6.52 cents, but don't ignore 6.52 cents. Probably if I am dealing it with a portfolio of 50 million, probably it will translate into a much bigger. For $100, for $1, I'm talking about an arbitrage opportunity of 6.52 cents, or probably for a face value of $100. For a face value of $100, I am talking of an arbitrage opportunity of 6.52 cents. But if I take that same to $100 million, probably it is 6.52 is going to be a much bigger number. Now this is where we have to really look at exploiting the opportunity. And if the discrepancy is much larger, that particular set of people who are exploiting these kind of mispricings in the market called as arbitragers, they will definitely try to profit by selling the rich and by buying the cheaper combination. So where and where there are more and more lot of deviations, this is what will bring to the concept of arbitrage. And we can see how arbitrage can be exploited. As I said, arbitrage is a riskless profit. I will definitely make a profit without any chance of losing in the future. And that we can accomplish through a replicating portfolio. We will try to see how we can create a replicating portfolio for this example, where there is a 6.52 cents cheaper, and how I can really exploit this 6.52 cents profit. Now, yeah, just to understand the arbitrage, though we are talking of law of one price, a strong foundation is required. There are a lot of deviations in general in the market, as we have seen in the example also. So the trades that generally happen are in the exploitation of this arbitrage opportunity. And anything which I am calling as arbitrage profit, it should generate a profit without any chance of losing money. But at the same time, we have to understand, because that kind of opportunity is available, the people called arbitragers, they are rushing for it. They execute it in bulk. Those kind of trades happen they are just observing, waiting for the opportunity. So once an opportunity comes up, they are really behind it, which means there is a huge demand that is getting created for buying the cheaper one and selling the richer one, which means the more and more buying and selling are happening, the cheaper one will start becoming costly because of more demand, and the expensive one will start becoming cheaper, which means that entire arbitrage opportunity is getting wiped away within no time. So any arbitrage opportunities that are available also, it is said that they are available only for a small period of time, because arbitragers are going to knock off that kind of opportunity. Okay, let's see how we can work out for that example. Let's see how we can create a replicating portfolio, and using that replicating portfolio, how we can really exploit the benefit. So we know that the the 0.75% coupon November 2011 bond is underpriced. We have already come to a kind of conclusion that it is underpriced. Now, I'll try to create a replicating portfolio using the three bonds. Here I'll take these three bonds because these three are the ones that are maturing up to that particular period. So I'll take the bond 1, 2, 3 from this Excel spreadsheet and create a replicating portfolio for this. So we know that this is the one that will be giving 0.38 cash flow after 6 months. This will be giving 0.38 after 1 year, and another 100.38 after 1.5 years. Now, as a part of the replicating mechanism, what I am doing is I'll create three different equations. Right? I'll create three different equations which will match the cash flows. Now, if I have to match this 0.38, right, I have to match this particular cash flow of 0.38. Now, what is that I can see if I have to combine these? Okay, what about this bond? What is the value? I'll first look at it with respect to 30th November 2010. For each period, I'll match the cash flows. 30th November 2010, this bond is getting matured, which means it is actually making 100 plus 0.625. It's making a payment of 100 plus 0.625. Right, on that day, the amount that is coming to that is 100 plus 0.625. Assume that I am investing some F1 in that. Similarly, what is the cash flow of the second one? It is going to pay only 2.4365 on that day. So 2.4365 times F2. And what about the third bond that I am using? It is also paying 2.25 on that day. 2.25 times F3. So these three put together should be equal to 0.38. This is one expression that I am creating. This is as of 30th November. Because I am using these three bonds, I am taking what are the cash flows that are coming on that particular day, and that cash flows multiplied by some face value. So otherwise it's better that I create all of them in the percentage form, because the face value will become much more easier for me to understand. So probably I'll call this as 100% plus 0.625% times. So let me take all of them in the percentage terms. So this also I'll take it as 2.4365% times F2 and 2.25% times F3, which will give me, which is equal to 0.38% times the 100 itself. So this is how I am matching my cash flows. Now the same logic if I am doing for 31st May 2011. Now by that time this is already matured, so I don't need to consider it. So only these two are there. This will pay the maturity amount now. So this equation will become 100%, or probably entire thing is in the percentage form. 102.4375% times F2 plus the third one is going to pay only 2.25. 2.25% times F3 should be equal to 0.38. And similarly, the last one, I will do one more with respect to 30th November 2011. The first two are already matured by the time. The last one is paying me the entire. So which means 102.25 percentage of F3 is equal to 100.38. So from here I'll get my F1, F2, F3. Right, so from here I'll directly get my F3. Right, for this particular bond now I can see what is the F3. F3 is nothing but 100.38 by 102.25%. 100.38 divided by 100 plus 2.25. This entire thing I am dividing it by 100. So this is giving me This is giving me a face value of 98.17. Right from here, now I should be able to find F2. F2 is coming out as 0.38 minus 102.4375% divided by 2.25%. Right, this is coming out as 0.38 minus 102. I will have to subtract F3 because F3 is already known. 2.25% times F3. So 2.25% times F3. This is the numerator part. And this entire thing is divided by 102.4375%. Right, 102.4375%. So I'm very much taking it as 102.4375, which is coming out as this one. So this is facilitating that I need to go for a short this much units of F2 minus 1.87. Right, so probably let me look at 0.38 or actually here it is not 0.38, it is 0.375 to be precise, because this is the cash flow. Okay, so it is giving me, and similarly now I can go ahead with F1 also from this expression. Right, how is the F1 coming out? The same, 100.625% of F1 is equal to 2.4365% F2 plus 2.25% of F3. So F1 also comes out as this amount, this cash flow, minus 2.25% times, right, F3 times 2.25% times whatever is F3 minus 2.4365% times F2. So this is in the numerator, and the denominator will come out as 100.625%, which is nothing but this much. So which is directly giving me some minus 1.779. So these are the face values that really need to be invested, which means I go long on this and I go short on these two face values. This is going to replicate the cash flows of the new. Now let's see whether it is replicating or not. Okay, now if we see the replicating portfolio, just trying to understand now, I want to replicate the portfolio's cash flows. Okay, now this particular one will pay a coupon of 0.625. Right, this particular coupon will pay, this particular one will pay on this day. Now the coupon and the principal, both of them are being paid, right? So what is the amount that is getting paid? This is the amount that is getting paid. This is the percentage that is getting paid, and on the face value is this much. This is the face value of the purchase that we are doing. Then similarly for the next one, it will pay only the coupon. So this much by 2 is what it is paying on that particular at the end of 6 months. and the face value of it is minus 1.79. Similarly, the third one, it is paying only the coupon on that particular day. The face value of it is 98. So overall, I am seeing that the replicating portfolio is showing that the amount that is paid on that day is 0.375. Similarly, you look at it here. Okay, what is the amount that is getting paid? It is the principal plus the coupon. This much is being paid on the face value of this much, and the next one is paying only the coupon at the end of 2 years, at the end of 1 year. This multiplied by the face value of it, giving me that the replicating portfolio also is giving. So buying one buying 1.75% November 2011 maturing bond is same as buying this particular 4.5% November 2011 maturing bond and going short on these two bonds for this much of face value. Now the third cash flow also, this one gives me a total of 1 plus 4.5% by 2. That much percentage is being paid on the cash flow face value of 98. So which means even this is giving me exactly the same cash flows. Now both of them are giving the new bond along with the replica of a replicating portfolio of these three bonds with this much of face values. Both of them are giving me the same kind of cash flows for the future, which means their current price also should be the same. Now let me see what is the current price, right? We know that these are the prices associated with each of them. So I will see what is the current price, right? So probably I can very well compute 98.15 into 100.55 by 100. Like that I can find out what is the price. The price of this particular bond is directly coming out by these divided by 100, which is coming out that okay, these are the face values now. Now for this particular face value, now for the 100 face value, this is the price. So for this much of face value, I want to see what is the price of it. Yeah. Now if I have to find the price of this, okay, 98.17 units, and the price of it is 105. For 100 face value, it is 105.85. For 97.17, I can very well find that this is the price of it. Similarly, for this particular face value, at 1 year maturity bond will have a price of this much. And for this particular face value, a 6-month maturity bond is going to have a price of this much. So overall the price of this combination is 100.26, whereas the price of this is slightly lesser. The price of this is 100.25, which means this is where there is a possibility of an arbitrage opportunity that could be generated, because this is the one, this is generating this much of face value. Currently this is the price that is available. This much of face value, this is the price that is available. This much of face value, this is the price. So there is a discrepancy in the price that is coming up, and so this is somewhere around 100.26, whereas in the market this one is available at exactly 100.19. So this is where the difference can very comfortably be exploited. So what I can do, I'll buy this particular bond, then I will sell this portfolio. I'll go short on this particular portfolio, So the cash flows are exactly the same. Whatever I'm getting at the end of 1 year, I'll pay the same. Whatever I'm getting at the end of 2 years, I'm going to pay the same. Whatever I'm going to get at the end of 3 years, again I'm going to pay the same. So because of this reason, what we see is, okay, instead of 100.38 here, I can even do. Okay, so this is giving me 100.2552, whereas in the market it is available at 100.19. So I could very well make that profit of 6.52 cents, because I will buy this one and I'll sell this combination in this manner. So because I'm selling it, I will get 100.25. I'm buying it today. I'm paying 100.19 to purchase it. I'm getting a 6.52 cents profit in the process. But in the future, there is no change in the cash flows. I'm receiving 0.375 by buying, and I have to pay 0.375 through this portfolio. So in the future, I have no other obligations coming up, which means I am making a profit which is assured of 6.25 cents. So that is the way we'll create a replicating portfolio, and I'll try to take the advantage using the replicating. So I'm buying the cheaper one, selling the replicating portfolio which is having a price of 100.252. That 6.52 cents is something that I am pocketing. That is the net proceeds, and in the future I have nothing to owe. And that is what we are calling as a replicating portfolio. And any small profit, don't think that 6.52 cents is a very small profit. I can scale it up. This is something associated with a $100 face value, but try making it with a $100 million face value. This number is going to be significantly larger. But because of heavy arbitrage that is happening, the prices of this are going to go up, and the replicating portfolio are going to come down until the two of them will become equal, which means the law of one price methodology of pricing, it is coming up exactly with the arbitrage pricing methodology. But of course, the arbitrage pricing methodology is very tedious because I have to create a replicating portfolio like this. But whether I use an arbitrage pricing methodology or the law of one price methodology, law of one price methodology is just the discount factors for each of the periods. Use those discount factors to do the pricing of the of any of the bonds that are typically coming up. But in some cases, even when we have looked at the arbitrage mechanism, we are seeing that the price of the bond is only 100.19, and 6.52 cents arbitrage is not really taken up. The reason is, in some cases, we'll still find the difference. The 6.25 cents or 6.52 cents, that difference is still existing. The reason is the model which we have taken did not take into consideration the transaction costs. In some cases, if the transaction costs are much higher, this profit is generally wiped up. So people don't want to take advantage of the arbitrage. This kind of anomaly can very much result in the, or which very much exist in the market. And remember, the prices that we have used, they are all mid-market prices. So depending on the bid and the ask prices and the spreads, there might be small set of differences that may exist. So even that differences may need to be considered before going ahead with a decision. And in some cases, the spreads could be wider, and in some cases, the spreads could be narrower. So even that could create a kind of a gap in terms of the differences. And here comes another important aspect, which is the idiosyncratic differences that are existing between the bonds. It does not go with the assumption that $1 that is received at a future date it really doesn't matter from which bond it is coming from, because all of them have similar kind of risk characteristics, because all of them are the treasury bonds itself. So that kind of mechanism does not work in reality, because the liquidity issues could be different, or the funding issues could be different. So there could be various other things that may come up, which means there are some level of idiosyncratic differences between the bonds. It's not that a $1 bond, $1 that is received at future from a treasury means whatever is the bond, the cash flows are the same. There is some amount of difference. Only in theory we talk about US treasury bonds are fungible collections. Fungible is I can use one in place of the other. It really does not matter. But that exists only in theory. In reality, we are seeing there are some level of idiosyncratic differences that are recognized by the market, and the prices of the bonds are typically reflecting those differences. And to understand that concept in much more detail, we need to understand the concept of strips. Till now, we have been discussing about the coupon based bonds, wherein a fixed coupon is paid at regular intervals of time, and a face value is being paid on maturity. But when I bring in the word of zero coupon bonds, there is no payment until the maturity date. And generally, the zero coupon bonds which are issued by the US Treasury, we call them as strips. And any coupon based bond can be converted into strips. Now, if I am saying, okay, there is a coupon of C, C, C and 100 plus C that are typically our principal plus coupon. Now, what generally happens is I can very well strip this entire coupon bond. Let's say this is the cash flow coming after 0.5 years, 1 year, 1.5 years, 2 years. Now, these can be stripped into 5 bonds, C, 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 P. So this is a bond which is a 0.5 year maturity bond with a face value of C. This is a 1 year maturity bond with a face value of C. This is a 1.5 year maturity zero coupon bond with a face value of C. This is a 2 year maturity zero coupon bond with a face value of C. And the last one is a 2 year maturity zero coupon bond with a face value of P. This is what is the stripping part. Typically, strip is an acronym standing for separate trading of registered interest and principal securities. Right? So here each interest and principal is broken up and they are treated as separate bonds altogether. So these are called as C strips. The coupon or interest specific strips are called C, and the face value related strips are typically called as the P strips, or principal related strips are P strips. Now you see the face amount of each of the C strips is the coupon which was there as a part of the original bond, and the face value of the P strip. These are all zero coupon bonds. No intermediate payment comes up. If you see here, any bond, if it is a $1 million, 3.5% coupon, a 10 year maturity bond. In 10 years, 20 coupons come up and one principal. So we actually literally convert it into 21 strips, 20 C strips, all of them paying this much of coupon amount on the maturity, and one P strip which does not pay anything in the middle. It pays only on the maturity part. Right, upon delivery of the set of strips, there is again a reconstitution. Assume up to here the strips have been paid off. So this bond can very well be reconstituted as a new bond. Right, these strips are typically paid off. Let's say 1.5 years is over, 3 strips have been matured. So this bond can again get reconstituted. But this is where, if I am packaging these bonds again, it is observed that the C strips are fungible. Means I can club the C strips of one bond with the C strips of another bond and I can create a combined coupon. But what is being said is the P strips are not fungible. So any C strip which is maturing on a particular date, I can use it towards the coupon payment of the bond on that date, but definitely not with the P strip. So when I am trying to reconstitute the bond, I will see some kind of differences with respect to combining the P strips of different bonds, but C strips of different bonds can very well be combined, which means C strips are more and more fungible, but P strips are not. One important thing that we have to understand. So, which means the P strips are inheriting the cheapness or richness, because they might be traded cheaper or they might be traded expensive, which is purely reflected based on the bond from which they come from. But that does not happen with the C strips. C strips can very well be integrated across. And typically the definition of the strip is more similar to that of your discount factor itself, because we are talking of a zero coupon bond that is paid again, paid after a particular point in time with no intermediate payments coming up. So this is where why the P strips are differing. That is what is coming out because of the unique characteristics. At some point when I have purchased the bond, the liquidity could be much higher, or the economic characteristics could be much different, or the funding availability could be much different. The credit risk that is being perceived at that original point in time could be much different. Because of these reasons, different bonds are perceived to have unique characteristics which is reflected in the pricing, which means I cannot use the law of one pricing as an appropriate approximation. And because of that, we see the C strips and P strips, both of them, though they are maturing on the same date for the last coupon and the principal, we see though they are maturing on the same date, their prices are going to be different. But that doesn't mean I can take an arbitrage opportunity. Though the cash flows are the same, their risk characteristics are different. So I cannot get into an arbitrage opportunity on that. And what is generally observed is, which are P strips that are getting created more from on the run, which is more like recent, right, currently issued, very much liquid, a long term kind of a security. From that, if I am creating a P strip, they generally trade rich. They are more expensive compared to their market, compared to their predicted price, compared to the other bond, because of heavy liquidity that happens, heavy volume of trading that happens. Financing is quite comfortable for those kind of bonds. So generally we find those kind of P strips are generally traded richer compared to the other set of bonds. And just to summarize, individual treasury bonds, they are not fungible. They have idiosyncratic characteristics which are reflected in their market prices. While C strips are fungible, the P strips are not fungible across the bonds. So the prices that inherit the idiosyncratic pricing of their particular bond issues. That's one important concept relating to the idiosyncratic pricing behavior of the treasury bond. They are not uniform. Whatever is the treasury bond that uh, that uh, I reconstitute, all of them may not behave with a similar kind of a pricing behavior because of this idiosyncratic nature. Now, moving forward, we look at another important concept called accrued interest, which we have initiated earlier in the session. And we have even used a simple equation which is called as a full price of the bond is same as the quoted price plus the accrued interest. Again, a few more terms. Full price is called as a dirty price, whereas the quoted price is called as a clean price, or even the flat price. And this flat price is the one that appears on the trading screens. So trading screens don't talk about the dirty price or the full price. It's only the quoted price that is there on the screen. and whenever I want to get into a buy or sell transaction of a bond, I have to even add up the accrued interest to it. Just take an example, we'll understand it much better. Let's say I have purchased a 10,000 face value of the treasury, which is paying a coupon of 3.625%, which is maturing on August 15, 2009. 19. I have purchased it on 1st June 2010. Because this is maturing on 15th August 2019, the coupon payments are like 15th August and 15th February, right? So I want to buy it on June 1st, means it might have got issued long back. Now I am doing it as a secondary purchase, secondary market purchase. So here it must have paid some kind of coupon on 15th February. How much coupon it would have paid? 10,000 face amount, right? 10,000 is the face value times 3.625% is the annual coupon by 2. So around 181.25 would have been paid on 15th February 2010, and the next payment is on August 15, 2010, another 181.25. But I want to purchase it on 1st June from someone. So logically speaking, I would be more eligible for the coupon between the June 1st and August 15th only, which is around 75 days. But the original buyer, which is the seller currently for me, who is selling this bond, he has held this bond. He is the owner of the bond from February 15th to June 1st. So he should be receiving the remaining portion of the coupon. So this whatever is the coupon 181.25, I should not be eligible for that whole coupon. This person should be eligible for the 106 days of the coupon, and I am eligible only for the 75 days of the coupon, because I am purchasing it somewhere in the middle. So the new purchaser, which is me, I am not entitled to the full semi-annual coupon. I am eligible only for the 75 days out of the 181 days. And the seller is eligible for the remaining coupon because he has held it from 15. But if I am the purchaser now, I am the owner, I will receive the coupon amount. Now this is where that coupon amount that is there between the two coupon payment periods, that is what we are calling as the accrued interest. So which means out of this we talk about 106 days out of 181 days that belongs to the seller. So which means $106.15 out of that 181.25 actually belongs to the seller, not to me who am purchasing it. Only the remaining amount actually belongs to me, which is to the extent of some 75.1. So what generally happens is, this is what we are calling as an accrued interest. The interest right from the previous coupon payment date till the settlement date. Whatever is the coupon that got accrued during that period, that is called accrued interest, which will go as a part of the pricing of the bond. Because the purchaser, it's better, because he would be receiving this entire 181.25 on August 15th. There is no point in going back and paying that, dividing it at that particular point in time. Now this is where, when you are getting into the purchase of the bond itself, we are paying the accrued interest to the seller on that settlement date, and on the day the company is declaring the coupon, the purchaser is keeping the entire coupon amount with him. And that's the reason whatever is the coupon, that gets added to the quoted price. Whatever is the quoted price, to that I will add 106 and say that that is the market price. So that will become the full price or the market price, which is the price which the purchaser has to pay to the seller to purchase that particular bond. But One thing is that particular full price is not quoted on the screens. What is shown on the screens is only the quoted price or the flat price only. Why is it so? Though it becomes easier buy sell based on the full price, but what you see in the screens, in the quoted screens, is not the full price, it is the flat price only. So why is this accrued interest convention? Why not include that accrued interest also into the price and just show the price? Now this is what happens. If you see here, as okay, let's say this was the day on which the last coupon has been paid, 15th February. And after that, what we could see is as the days are getting increased before the another coupon payment date, before the next coupon, we see that the accrued interest is piling up, right? And even if you look at the full price, it is the present value of the future cash flows. In the future cash flows, this is the coupon that is there, and as I am approaching closer and closer, the present value also increases, or in the other sense, the accrued interest also goes up, because the seller is holding it for a longer period. The accrued interest is going up, so the full price of the bond is actually going up. It goes the same way until you reach the coupon payment date. So the full price changes over time even when the market is unchanged, because nothing has changed. Market is very much plain, but still during this period the full price is going up because we are seeing that it is approaching the coupon payment date, and suddenly once the coupon is paid, the price of it is falling, because this coupon will no more be included as a part of your future cash flows. And at the same time, because the coupon is already paid, we see that the accrued interest is no more. So suddenly the price of the bond is going to fall. Now this in the real market creates a very big problem. What has happened? Why did the price of the bond fall such drastically? Now this is for the important reason. Now that the coupon has been paid, there is a flat drop in the price of the bond. But that is very difficult for us to understand. So that's the reason the traditional convention is, this will create a heavy volatility of the bond market, which is not actually because of the market changes, but because of a coupon payment that has actually occurred. Now because of this reason, we see that tracking wise, we see the flat prices only. We negotiate with the flat prices only because flat price does not change. It hardly changes. It's a very gradual change with time. You see it is falling very marginally. So over a long term, this comes up to the maturity. It approaches the face value. So what we could clearly see is that difference and this gap becomes very wider, and that's the reason it's better to understand the real movement because of the market changes. It's better to track the flat prices only rather than the full prices. So within a coupon period, the full price of the bond increases over time, as we are seeing, as the bond payments are going closer and closer the coupon towards the coupon period. So just before the coupon paid, the price is at the peak, but suddenly after the coupon payment happens, the price falls drastically by the amount of the coupon payment, because that coupon is no more included as a part of the present value of the future cash flows calculation. So that's the reason we depend more on the flat price being shown on the quoted screens rather than the full price. And if you see here, we have said out of that 181.25, we have said that 75 days are held by the new buyer and 101 days are held by the seller, and based on that we have divided the coupon. So these are the actual number of days, or sorry, 106. These are the actual number of days, which means between February 2010 and 15th August 2010, which are the two coupon paying dates. There are exactly 181 days between them. And when I take the difference with respect to 1st June 2010, when the settlement is actually happening, 106 days from 15th February. So we are distributing the coupon, which is the accrued interest, in terms of actual number of days from the past coupon payment divided by the total actual number of days between the two coupon payment days. This is what we call as the actual by actual kind of a convention. Actual number of days between the coupon last paid and the settlement date. Actual number of days between the two coupon periods. Right? Because it's purely for the computation of the accrued interest. In some cases, we see that actual by 360 is the convention that is being used. Means here, this remains this itself. But here it is looked at as year. The year means 360 days only. Here it's not taken as actual number of days. It is looked at with respect to 360 days, which means every month is around 30 days. So depending on the months, we can very well look at how many actual number of days. So this is the one that is used for the money markets. So typically for short-term discount securities, and in the interest rate swap, if I want to get into the floating leg pricing, we will get typically into the usage of the actual by 360 mechanism. And there is one more mechanism which is 30 by 360. Even this is not taken in terms of actual number of days. This is looked at in terms of the assumption that a month is only 30 days. It really doesn't matter whether it is February or March. Both of them are treated as 30 days only. So date to date. So which means like 15th February 2010 to 15th March 2010, I take it as 30. So April another 30, 15th April. 15th May is another 30. Now after that, so 90 are there, 16, 17, 18, 19, 20. And after that I go up to 30th May, 31st May, 16. So this is where gives me, this is what will give me, here it is 30 days, here it is 30 days, here it is 30 days, 90. And we are also talking of another 12 days, which is giving me 102 days, or sorry, 16 days, right? 17 days, right? 15th May to 1st June, it's another 17 days. So it is giving me 107 days between the two, which means on the other side it would be only 74 days, not 75 days. So this is how it is treated. The number of days are treated as 30 for every month. So 360 for the year. So that is what is the convention which typically goes for corporate bonds, and even in the interest rate swaps. When we are getting into the pricing of the fixed leg of the interest rate swap, we are using the 30 by 360 convention. So these are the three different forms of convention that are used for the computation of the accrued interest. So just to summarize what we have covered in this session, we have focused a little bit on the cash flows that are coming from the various fixed income government securities. We understood what are the price, how do we look at the prices, discount factors, what do we mean by law of one price, how we can get into arbitrage opportunity, how do I replicate a portfolio creation, replicating portfolio, how do I create for a specific set of cash flows, why does the market price differ from the predicted price. We have understood a bit on strips and the idiosyncratic pricing behavior of the various treasury bonds. What is the fungibility, in which cases the fungibility of the cash flows exists and in which cases it does not. What do we mean by accrued interest? What are the pricing implications of accrued interest? And finally spent a little bit of time in terms of understanding the different day count conventions. Alright.